So the IRS just announced 5 new warning signs of a potentially incorrect ERC claim. So I want to go through those 5 signs with you because I think these press releases are really interesting. It really gives insight not only to how the IRS is going through their enforcement actions, but also how they're thinking holistically about the ERC. So I'm gonna go ahead and share my screen here and walk through this step by step so that we can discuss exactly what it might mean for your business and how to correct any errors that you might encounter. So here's the press release right here. First thing we notice is warning signs of incorrect claims. And so the IRS goes through and it kind of gives a little bit of background here, and they talk about the complexity of the ERC. And, it's a complex tax credit. It's got a couple hundred pages of rules attached to it as articulated in various notices. And those notices reference the original law that Congress passed as well as other parts of the Internal Revenue Code. There's a fair amount of complexity here. And there's been a lot of talk from the IRS about aggressive promoters and fraudulent claims. And so back in 2023, the IRS put the processing ERC claims on hold. So recently, the IRS did announce that they have digitized about 1 million ERC claims. And there's about 1.4 million pending in queue right now. So there's about 1.4 million claims. They've digitized about 1 million of them. They've learned some lessons as they've gone through this process. And so a couple of weeks ago, they stated that they're going to be issuing letters denying tens of thousands of different ERC claims that are clearly erroneous. And it's interesting because, the IRS is going through, they're getting better about understanding when mandates were in effect in different jurisdictions, different states, different geographies. And so broadly speaking, they're wrapping their hands around it. But, having seen some of these denial letters, we've also seen that oftentimes there are specifics that are applicable to individual industries and or businesses, modifications that were required by different regulatory agencies as a result of COVID that aren't always, that the IRS doesn't always have access to. So they're looking at a broad state level. But even, for example, I live in California, there's a number of different regulatory agencies depending on the industry that issued different requirements for how to operate during COVID. And while we had some very high level start and finish dates, there were some regulatory agencies and sometimes counties that continued to take a different approach than what was going on at the state level. So with all that said, the IRS is going through this process. They are issuing payments in claims that they see as relatively low risk. Sometimes they're issuing partial payments to clients or taxpayers where they are making 2, 3, 4 quarters of payments, but then they're holding off 2, 3, 4 quarters as well as they go through and validate the claim. So all this to say that there's a lot of claims to process and the IRS is going through this piece by piece. What are the 5 newly announced signs of potential errors in your claim? So first one's really interesting. There's this comment about essential businesses that could fully operate and didn't have a decline in gross receipts. So a lot of essential businesses filed for the ERC. And one of the key things that the IRS says here, and this is also reflected in notices, is that if a business could fully operate, e.g. there weren't mandates that resulted in the business having to modify how they engage in operations, how they conduct business, then that business is eligible unless it has a decrease in gross receipts, which may be the case. But if you don't have a decrease in gross receipts and you don't have any mandates that are applicable to you, then you aren't eligible. Now, a lot of essential businesses have reached out to, what does this mean? Well, keywords here. One, if it could fully operate. So you can see when you read through here further that in many instances, essential businesses weren't eligible because their operations weren't fully or partially suspended. So again, the key thing here is not whether you're essential or not essential, to use that term that bothered a lot of people during the pandemic, but were there mandates that were applicable to essential businesses? And if there were mandates applicable to essential businesses, did that result in a full or partial suspension by a qualifying government order? Well, that goes in the second point here, which, well, what is a full or partial suspension? So you can see here that even businesses that have government mandates, whether you're essential or not essential, you have to be able to demonstrate how that mandate resulted in a full or partial suspension of business operations. And so a full or partial suspension of business operations is a lot of words, a lot of documentation, a lot of explanation of this in the notices, but the crux of it is that more than a nominal portion of the business operations were suspended. So what does that mean? Well, when you read further into the notices, a key phrase in there is that the ability of the business or the taxpayer, the ability to provide your goods or services in ordinary course was reduced by more than 10%. So if the ability to provide your goods and services in ordinary course was restricted by these government government mandates that you can demonstrate that more than a nominal portion of the business operations have indeed been suspended, resulting in a partial suspension of operations. There's a lot of judgment that goes into this, a lot of documentation that goes into this. And one of the key things is that the IRS says that when asked for proof how the government orders to suspend more than a nominal portion of the business, a lot of businesses are having a hard time providing information to. So whether a business was fully or partially suspended depends on the proof that they're able to provide that demonstrates how the order affected their operations. So a key part of this is having a documentation, what we call contemporaneous documentation, that demonstrates that a specific order was applicable to the business and what the results are. What were the modifications? What were the changes that you put into place in your business as a result of these orders? So those are two key areas, and both of these are outlined and highlighted in the notices. Now, a couple of other ones, the other three that the IRS puts together is what I call more calculation errors. So family members disqualify wages. So there's what's called a related party test, a related individual test. And so the easiest way to think about this is that if anybody who's related to the majority owner of the business is not eligible for the purpose of the ERC. So if you have a spouse or children or grandparents, brothers, sisters, stepfather, stepmother, nieces, nephews, aunts, uncles, in-laws, whoever it may be. So if anybody's related to you, generally speaking, in almost every scenario, these related individuals are not eligible for the purposes of the ERC. So that means you have to exclude their wages from your qualified wage calculation. So this is something we see come up quite a bit, where the client may have thought they were eligible, they filed for the ERC, and then when they went through and they did all their calculations, they just included everything, not realizing that there were certain people they had to exclude. So you have to go and exclude those wages, those individuals from your wage calculation. Now, another one is double dipping. So ensuring that you're removing any proceeds from the Paycheck Protection Program from your wages before calculating your qualified wages. So very clearly, there's a lot of confusion about the early days of the pandemic when this program was just getting started, because back in 2020, the IRS actually had a rule that said, well, if you got the PPP, you can't claim the ERC because you're double benefiting. And at the end of 2020, Congress, that rule set was changed. So then retroactively, it became that you could take the PPP and the ERC, you just couldn't double dip. You couldn't claim the ERC on wages that were paid through the Paycheck Protection Program. So there's a very specific process that you have to go through to pull out the PPP proceeds from your wage calculations when you are calculating your qualified wages. So, and it's not just the PPP, right? But PPP is the big one. There's other types of wages you have to pull out, including FFCRA benefits, which were basically paid family medical leave as a result of COVID. Well, those wages, if you claim them, were reimbursed through a tax rebate, as a tax credit as well. Well, oftentimes those wages were overlooked and the taxpayer double dipped. There's also research and development credits or work opportunity tax credits. There's a number of different tax credits that if you received, you have to ensure that you're not calculating a ERC tax credit on top of these other benefits you receive. So it's a very clear process. You have to make sure you pull these out before you calculate your qualified wages. And if you did, then there's a mechanism to fix this as well. Now, lastly, this is a big one. Large employers claiming wages. So a lot of folks were unaware that there was a limit on the full-time employees. Basically, the number of full-time employees limited the amount of ERC you were able to claim. So there were two different types of limits. So one, in 2020, if you had more than 100 full-time employees, then you were ineligible for the 2020 ERC. 2021, if you had more than 500 employees, you were ineligible for the ERC for 2021. Now, there's a couple of nuances here. Now, this full-time equivalency count was based off your 2019 employee count, not your 2020 or your 2021 employee count. And so oftentimes this was either completely overlooked or the calculation was made on your 2020 or 2021 numbers, not your 2019 numbers. The other nuance is that what is a full-time employee? So there's a very specific definition and calculation and a way to determine whether or not an employee is full-time, and it's listed out in the notices as well. Effectively, there's a number of hours worked test that you have to go through, and it can be quite tedious. If you're looking at 500 employees at a time, you have to look at the hours worked in every either 2-week cycle or monthly cycle, depending on how you pay the employee, and whether or not that employee worked more or less than a certain threshold per pay period, per week. And then once you have that number per week, per pay period, per month, per year, you have to take the average amount every single weekly, monthly pay period, average that over the course of the entire year to determine whether or not you had more or less than this full-time equivalency count. And so again, it can be quite tedious, but it's critical. And the reason that's critical is because a large employer, while it can be eligible for the ERC, the wages in which are qualified wages are very, very different. And so as a small employer, if you were qualified, all your wages were effectively eligible in order to calculate your qualified wages. However, if you're a large employer, only specific wages of employees who were being paid not to provide services during the suspension of operations or the time there was a decrease in gross receipts during eligible quarters, those wages were eligible to be determined as qualified wages. So this is a big one because this could effectively make a business eligible or ineligible during a certain time period. And so if you're closely to either that 100 employee or 500 employee threshold, critical that you go through and analyze at a very detailed level the number of full-time employees that you had in 2019. Now, remember, it's not just head count, right? This is hours worked. Oftentimes what we'll see is the IRS will say, well, you reported 120 employees on your 2019 941, you're ineligible, right? Oftentimes if you have part-time employees, you have turnover, then you might actually have substantially less than the number of employees that were either reported in 941 or in your W-2, W-3 form. So very important that you have good documentation there. So those are the 5 new warning signs. Really what I look at these is a lot of these are calculation and documentation errors. It's a lack of substantiation, a lack of calculation, or errors on calculation. So if it's a calculation error, very simple to fix. You can, if you haven't received your ERC yet, you can amend your amended return to correct it. There are withdrawal programs. If you determine that you filed an error, you can't withdraw it. And just because you don't have this documentation doesn't mean you can't go get this documentation. So we urge you, if you don't have, for example, a report that articulates exactly how you were suspended in specific government orders, go ahead and get those. Go through the process, download the government orders, go back, interview your key staff, your key employees, document exactly what did you have to modify? What was the impact in your operations? How were you unable to provide your goods and services in ordinary course? Make the case, because effectively that's what the IRS is asking for. And this is all based on the notices, and they're saying that we need more documentation. You got to be able to prove your position. So hope this is helpful. And if you have any questions, feel free to reach out.